In 2025, have you been thinking about buying an investment property in Darwin? The yields are pretty attractive.
It's not uncommon to see a yield there with a 6 or 7 in front of it.
And the price point is pretty low to get into.
Let's say our budget is 525. So far, we have 5.
But apart from high yields and low buy price, what else do you need to know about Australia's smallest capital city?
This is the one thing that everyone needs to know before they buy in Darwin.
We've assembled an expert property investing panel that are going to lean on not only their property investing skills, but their professional expertise as well. Kicking it off with Jeremy Iannuzzelli, property investor with a $20 million plus portfolio and accountant to some of the most successful investors in the country. Jeremy's going to be unpacking what you need to understand about Darwin from an investment and taxation point of view.
If I was investing in Northern Territory, I would treat it as a transactional purchase. Get in at the right price, exit at the right price. You can actually hold this property in a trust. Now, one of the beautiful things is that there's no land tax.
Then moving over to investor and mortgage broker Max Phelps, who's going to open up details about lending and things you absolutely need to know before you invest in Darwin.
The thing that you really need to understand is that can really kill your portfolio growth. Some people do really well buying at this time. Just be really, really careful with a volatile market like this that you don't end up in negative equity.
And finally, we jump into Darwin's data using the expertise of none other than property investor and data analyst Gilbert Melgar. There's a Jan 22, Jan 21, Jan 20. There's some real spikes around January as far as rental demand.
There may be a seasonality factor in there. So the median price pretty flat since end of 2022.
There's some potential for capital growth here, plus I can get some pretty good yields. Is there anything else you wanted to talk about economically for Darwin?
The trick here is to understand the difference between...
If you've been thinking about buying an investment property in Darwin and want to lean on the opinions of an expert panel of very accomplished property investors, you're going to enjoy this episode. My name's Todd Sloan. This is the Pizza and Property Podcast. And this episode is made possible by InvestorKit, Property Strats, Praedium Partners, Property Developer Network, Suburbs Finder, and Golden Eggs. More about our awesome show sponsors in the links below. But right now, let's kick things off with Darwin by chatting with Jeremy Iannuzzelli. Jeremy Iannuzzelli, how you going, man?
Very well, mate, very well. And I can promise you behind me is not a screensaver, but an actual fish tank with a lot of my son's fish that he has gladly named after a whole bunch of PJ Masks characters. So,
do you have a dory in there?
We don't have any dories in there, mostly cichlids, but it's a struggle trying to stop our little son Sebastian from getting his hands in there and playing with them because he does think they're toys.
Hey, for anyone that's listening on iTunes or Spotify, Jeremy's got a fish tank behind him that I thought was fake when he first turned it on. It looks like a fake background, but anyway. Mate, I want to talk Darwin with you. I want to talk about this with you I want you to wear 2 hats really. And this is the whole reason I wanted to kick this episode off with you, because the property investor hat, obviously you've kicked some very serious goals, but then also the accountancy hat, you can really talk everyone through a lot of the detail navigating an area like Darwin, because it's not the normal kind of location. And I don't mean that in a positive or a negative. I mean it for what it is. There are some variances that really need to be considered. So is there anything you want to set the stage with before we get into everything, mate?
So absolutely. So I want to put my hat on first as a property investor and really set the stage around what I'm seeing in the market there, especially with a lot of clients that I manage. And I do manage thousands of property investors and do manage a number of, leading property advocates in the country. So I get to see a whole bunch of things of where people are buying and the trends. Secondly, I want to talk about my experience of Northern Territory. Being an accountant over the last, 15 plus years, I've got to see that market and where people have bought there, when people have bought there and how it's performed. So I really want to share those war stories, because I think war stories tend to really give you a lot of perspective of a particular area. I really want to give you my thoughts and opinions on Northern Territory itself. And again, no financial advice, but just genuine my opinion from seeing that area over many years. Then moving forward from an accounting perspective, I really want to share with people about, if you are going to adopt certain strategies buying in the Northern Territory, well, what type of things can you do to really enhance your position? How can you take advantage of that state? And some of it's really good, lucrative tax strategies that people are implementing there, where you can walk out with the best bang for buck for your investment. So they're the kind of things I really want to discuss with everybody today, and potentially some strengths of the area, but also some risks of the area. So you kind of go into it with your eyes very wide open, understanding what your main business plan is for that particular state and that purchase, and then an exit strategy. I think exiting is quite a strong point that a lot of people don't emphasize on when buying property. It's kind of just, yep, we get the buy-in side right. But if we don't get the exit strategy right, then sometimes we can be left holding assets which could potentially have negative equity or may not suit our business plan anymore. So that's kind of the fundamental points I want to raise when we talk today, so people go in with all the knowledge, things that, you know, I'm fortunate enough to have learned over many years, and getting to see many successful clients there execute those transactions.
I do want to talk to you more so about the exit strategy, because I'm 100% with you on that. I think that that's something that might get glossed over that really can't in this case. But whilst the review mirror is always clearer than the windshield when it comes to investing, I do still think it's important that we dive back a little bit historically and open a bit more up about what you were talking with Darwin. So what have you seen over the past 10, 15 years as an accountant and an investor that's helpful for us to bear in mind?
So I want to start with, say, Northern Territory Darwin in general, where, you know, that 2010 to 2015 environment was quite a strong market. I literally saw prices double for many clients. And then leading through, you know, 2017 onwards to where we are now, prices did dip quite substantially. We're talking in some areas, in some suburbs, over 30%. And people just could not get rid of these properties. Although rents, you know, in some parts of it flattened out and stayed quite strong, and some others dropped. But, you know, that's that Darwin in a nutshell. It tends to have those really strong times when industry around it's very strong, gas fields, and there's exporting there. But if those things take a bit of a backward step, all of a sudden you've got this particular state and the particular industries involved really retracting. And we've also got to remember that Northern Territory itself, by memory, has a population of just a little over 250,000 people. Now, to put that into context, if we're looking at western suburbs of Sydney, and if anyone's listening, western suburbs of Sydney would be considered one of your major areas of the Sydney basin, that itself has a population of over 500,000 people, where the area would be probably, I would argue, to say, you know, 1/50th, if not 1/100th of Northern Territory by landmass. So we're talking a smaller population which is subject to material changes in the economy, which can fluctuate population and therefore fluctuate supply and demand quite substantially.
So what I'm really hearing there is potential volatility.
Absolutely. When you've got such a small amount of population there, if you've got, you know, people leaving, that really materially affects the housing supply in that particular area, say as Darwin. But at the same time, if you've got an influx of people, you know, going there for migration purposes to speed up their permanent residency, or taking jobs on offer, because Darwin has got an industry very closely linked to gas. So there's a lot of agriculture there as well. That can increase demand. You know, we're talking in the space of months. So being a smaller population, it is subject to smaller movements of volatility, which could impact the price positive or negative.
Can you open up that a little bit? Because I feel like that's actually a really interesting point to touch on, that if someone has migrated to Australia and then moves to Darwin to speed up their permanent residency, because the time frame to become an Australian citizen collapses the more regional you go. Is that right? Or have I got that kind of right?
Not a migration lawyer, but from experience, yes, you do have, it's a points system, and you do get extra points for, you know, locating or working in regional centres. And the whole purpose is that you're providing labour in an area that may need that labour component. So it does help and go towards speeding up the process of permanent residency. But typically speaking, what we see is that, you know, people go there, speed up their permanent residency, do what they need to do. Maybe on average, half may settle there and call it home, and the other half may go to major regional centres or major capital cities of states to obviously have a more concrete form of employment or higher paying jobs. So that's something that you do see with a lot of these regional centres. I know Tasmania was a benefactor of it. I know South Australia was a benefactor of it, and regional areas of New South Wales, lots of people going there to speed up their permanent residency.
And whilst you obviously never want to make a decision based on one data point in isolation, to me, the reason I just wanted to highlight that is because if 5,000 people move to Melbourne or move to Sydney, it doesn't shift the needle. But if 5,000 people move to somewhere that's got a population of like 200,000, that can really move the needle. And looking at the amount of migration that we've had, that looks like that's probably a data point really worth paying attention to, if it's more attractive if you've just moved over here from another country to maybe speed up that PR.
good when Gilbert comes on board to really share the data sets of Northern Territory and Darwin itself, because I think that population migration in and out is a very important factor to consider, and the correlation of prices. So if you've got, substantial amount of people moving in, how does that impact the price? Common sense says it goes up, but then you've got a significant amount of people leaving, or could be a smaller amount of people leaving in comparison and contrast to other states of Australia. Well, then what does that do to prices as well? So I've seen that. I saw when industry was quite hot there, prices absolutely doubled, a very strong local property economy. And then through 2016-17, yes, in correlation with the Banking Royal Commission starting at that particular time, but I did see a drop and a flattening of yields, and in some cases, yields coming down. But I suppose what's happening now, and again, seeing, lots of clients' movements and migration in the property economy, lots of people are starting to buy there. Buyers agents especially are starting to notice the very strong and attractive yields. It's not uncommon to see a yield there with a 6 or 7 in front of it, because what's happened is you've had price suppression from the property's perspective, so it hasn't really grown a lot in the last, say, 4 or 5 years. You've had yields continuing to increase or rents continuing to rise with inflation. All of a sudden, you've got now a very attractive property which is starting its growth cycle up, sitting on very high yields. So as an investor, we're very attracted to that. We're all attracted to rental yield. It's great to tell your friends at a barbecue you've got a property with 7% yield, but at the same time, we're starting to see a lot of price movement. And I'm noticing it from where clients were buying last year, for prices with a 4 and 5 in front of it. We're now seeing more 5s and 6s. But still strong rental returns. And, if enough property advocates and enough buyers agents and investors alike start to really get on the bandwagon of Darwin as an investment area, we will start to see some price growth in that space.
I want to talk to you about structures, but I want to talk to you about it through the framework of potentially selling, because some people I'm speaking with are talking about Darwin through the lens of you could do really well over the next kind of 12, 24 months, more of a transactional get in, get out type situation. If that was what someone wanted to explore, what kind of a structure would they really want to hold it in to best minimize tax?
Well, I'm going to not sit on the fence, Todd, and I'm going to say that if I was investing in Northern Territory, now very openly I don't have any properties there, but if I was investing in Northern Territory, I would treat it as a transactional purchase, a genuine transactional state where I'm trying to get in at the right price and I'm going to exit at the right price and maybe move that money and pivot into other areas. Now, one of the beautiful things about Northern Territory itself is that there's no land tax.
Yeah, awesome.
So you can actually hold this property in a structure, say, for instance, like a trust, which is going to give you ample opportunity that when you do exit, and hopefully exit with a very large capital gain, you've got the opportunity to be able to then distribute that profit the way you want to beneficiaries that are and have a lower marginal tax rate than you. And you're not going to have that cost of land tax impeding your decision of going into a trust and then being able to minimize the capital gain. So you might be buying there, it might be cash flow positive, it might be slightly negative, which that means you carry forward the losses for when you make profit. But if your goal is that, hey, I don't want to be caught in this market when it's coming down and I may have extracted the equity, I'd like to realize my profit, then a discretionary trust is going to be the best entity to realize that profit in. If you've got those beneficiaries there that you can really distribute the money to and effectively lower the tax that you need to pay on the overall exit of that property or the exit of that portfolio that you've created in Darwin. So there are some substantial benefits there with the right structure in place where you can get in, get out, liquidate, make the actual real physical cash gain, distribute, lower tax and walk out with more money in your back pocket.
Jez, you just said something that I'd like you to open up in a little bit more detail. Carrying forward losses in a trust, because if you're new to property investing and you might not be aware, you can't negatively gear in a trust the way that you can in your own name. Could you open up a little bit more about how that works?
Yeah, so it's a separate legal entity, a discretionary trust. Any losses that you accumulate from the expenses being more than the income, those losses are then quarantined in the discretionary trust itself and carried forward for, the vesting life of the trust or when they're utilised by profits. So you can't get a personal tax benefit in your own name from losses incurred in a trust. They stay inside the trust and then utilised when profit is made from either rental operations, meaning income more than expenses, or when you make a capital gain. You make a capital gain, you utilise the losses, and then you distribute the net balance to the beneficiaries after that. So again, if you're looking at this from a transactional basis where you're looking to enter, hold it for maybe 1 or 2 years or maybe slightly longer depending on what you feel the right time to sell is, exit, you're not really hurt too much by not being able to claim those losses in your own personal tax return, because you're still getting that layer of benefit by absorbing those losses and then distributing the net proceeds after that.
Makes sense. And this is why it's so important to talk to your accountant before you buy. You can't change this stuff afterwards. Well, you can, but it's just extraordinarily expensive. It's not worth it.
Very costly exercise. You've got stamp duty in most cases and capital gains to change the structure. So I think it's important to really note and understand what is your business plan for the area. Mm-hmm. If you're looking to hold long term, then, that's fine. You can purchase in various different structures. But if you're really trying to treat this as a very transactional property investment, mm-hmm. where I'm going to get in, going to get out, and I really want to make sure I retain as much of that profit as I can, well, that's a great opportunity to utilise, say for argument's sake, a discretionary trust. If you do it in your own name, and obviously if you're doing it with inside a super fund has its own taxing implications, but in most cases, if you're holding investments longer than 12 months, with a 1/3 discount accompanied by the 15% super fund tax rate, the overall taxing percentage of a capital gain that's been made in a super fund for assets held longer than 12 months is 10%, Todd. So it could be a really good investment depending on your strategy and depending on the way that you want to treat your super fund. It could be a great investment for your super fund, but you should be speaking with your financial planners and other consultants to make sure that it's right for you.
I'm not going to ask you to repeat that because that was so information dense, but if you are looking at investing in your super right now, rewind that last 30 to 60 seconds because there was a lot of gold in that, what Jeremy just said. But mate, I wanted to move on to negative equity, because if it does happen, we hope history doesn't repeat itself in that sense of get like boom times and then bust times. We're really hoping everyone's going to get a boom out of it and then maybe sort of stable off instead of going back down. However, negative equity is a real potential thing. Again, from a taxation point of view, what do people really need to be aware of if that does happen to them?
I think I've seen in my years in my career as an accountant, I've actually seen people have negative equity in their property portfolio a lot more times than people think. I would say I've seen people buy properties in areas heavily linked to industry that's around the raw mineral sector. Mm-hmm. I'm not going to necessarily name states because I know there's a lot of people buying there at the moment, but if you're buying in areas which are linked heavily to industry like that, I've seen prices double, if not triple there very quickly. Mm-hmm. People extract the equity out because wow, my property's gone up, $200,000, $300,000, $400,000. I'm going to extract the equity out to 80%. And then I've seen the reverse happen. I've seen gas fields turn off. I've seen coal mines become not feasible. I've seen, job losses in the thousands in those particular areas. And I've seen then equity pull back anywhere between 30 to 40, if not 50% of its peak. Now, it doesn't happen all the time, but I have seen it in my clients' portfolios. And what that means is people are sitting on loans that are substantially higher than what they could sell the property for. And that's forcing these people then to hold the property even through periods of higher cost, negative gearing, and they just simply can't sell, because if they were to sell the particular property, they'd be left with a debt on that asset that they no longer hold anymore. So that is a genuine risk when you're buying in, say, these very regional centres, especially in Northern Territory where the population is only around about the 250,000, slightly above mark. Those small movements in population could change the property economy there quite substantially. So when times are strong and you're rising, sometimes it's not a bad decision to take some money off the table, but again, it all depends on your business plan and property strategy. But if you are going to extract equity out, you need to be very mindful and understanding of what that market has done over, say, 20 years. And if you've seen it go up sharp 20, 30, 40, 50% and pull back 20, 30%, yes, still a growth from when you purchased the property. But if you're extracting the equity up here and it's, reverted back down to here as a level, you've got to be very careful, because it could force you to hold that property a lot longer as you've extracted that equity and then maybe use that to buy another property.
And we're going to talk with Max a lot more about actual loan types and how to make sure that you're as protected as possible. Again, I don't want to turn this into a negative, but this is something that has a possibility to it. So making sure that you're protected against all negative possibilities, the more protection you've got, the better. But mate, what I'm really hearing there is if you're getting some amazing gains and you're like, mate, like, let's pull out some equity. This is so good. Be really careful cashing in all that equity, because if prices do move, even if they come down a bit, you could potentially be negative equity. Even if you've still bought lower than where the value is, if you've cashed in even more, you could be holding a debt that's much larger than your asset value.
Absolutely. So, in short, on my end, I do see a lot more buyer activity. Again, I didn't see any of my clients buy in the Northern Territory from about 2016, 17 onwards. Mm-hmm. So it's been, quite a long hiatus, especially with my clients being very active in the property space. But in the last 12 months, I've probably seen that trickle from about half out of every 10 transactions buying in Northern Territory, especially Darwin, to now I'm probably seeing anywhere between 3 to 4 transactions happening in Darwin. So that's a substantial increase in the past 12 to 18 months. And it could be a really good thing. We saw that happen with WA. It really shot up and everyone from the Eastern Seaboard was buying there in the dozens. But as soon as that tap starts to turn off and the equity that, that people have extracted from maybe Eastern properties that were moving to the Western side, if that's no longer there, then you're really relying on the internal economy of WA transacting in properties. And again, Northern Territory, if you're having to rely on the internal Northern Territory population transacting in properties, it's kind of a shift of the needle sideways. But if you've got more people coming in from other states or purchasing in an area where the population's only $250,000, you've got now a substantial amount of transactions occurring. So I just want to make sure we make that clear. We've got, 26, 27 million people living in Australia, of which, say, arguably 10 to 14 million of those are adults. Mm-hmm. If we now have 250,000 Australians wanting to invest in, say, Northern Territory and buy property there, and the population of Northern Territory itself is $250,000, all of a sudden we've got a huge amount of demand for property in that market, whether it's real or fake. And that's very clear. So it's a really good opportunity for investors that if there is a drive, a herd moving to that market and there is a demand that's there, you can get in and potentially get out and make some really good bickies along the way, Todd. Then that is a really good pivot into buying in, other locations where you're able to gain a substantial amount more cash through making a really good property decision.
Mate, I love this. I want to wrap this up with your top 3 steps as far as getting to understand an exit strategy that's right. Let's break this into like a bit of a, who are you talking to? What do you really need to ask yourself? Like, how can people start putting this together?
So I think your age is important. That's first and foremost. Do you have time in your career, in your life, to be able to really hold these assets long term? If you're a young kid and you've got 3 or 4 or 5 cycles to go through before you retire, then you typically can decide to hold these longer terms and go through its various cycles. Middle-aged, bit shorter time, and if you're older, obviously a lot lesser. So you're looking for really good decisions, and they need to be sharp because that's going to lead to a very healthy retirement. So that's number 1. Age is important. Number 2, what's your plan for that property? Is your plan for that property to try to generate cash flow, or are you after a capital return? And if you're after a capital return and you've got a plan to pay down your home, for argument's sake, well, then this could be a really good area where you could get in and get out, make a chunk of money, really minimize your tax, and then use that to pay off your home loan. And if you're much older and looking to hold this long term, it's something you do need to consider. Do you have those waves? And the last thing around your property strategy is make sure that you're buying a property where you can actually exit from it later on at time. And I think that's important. You want to be buying a property that's still desirable, even if it's not to an investor, still desirable to someone who may be living in Darwin itself. Mm-hmm. Because if you're buying very investment grade properties in streets that the locals actually don't want to live in, mm-hmm. Or it's a property that's just
studio
too
apartment.
far gone, studio apartment, or whatever it may be, you still need to make sure that you can exit from this property, and you don't need, say, another investor trying to buy it, because they're going to be looking at the same numbers and the same parameters you are of why you're exiting. So have that plan of when you're buying this particular property. If you are looking to make an exit strategy on it in 1, 2 or 3 years, have a bit of a think of who's going to be my target market to sell this to. And I think that's important. We always hear, don't buy a property next door to you, buy something that, can afford and invest in. But if you're going to these areas where, there could be a little bit of a stronger market or a weaker market, how can I sell this potentially in a weaker market if I need to?
So recapping, how much time do you have? Are you looking at this over, I'm 22 years old, I'm just getting in and I've got 3, 4, 5 cycles? Or are you maybe a little bit more time restrained? First thing to consider. Then next thing to consider is, what's your plan? Are you doing this for capital growth, or are you doing this for cash flow? Because that's going to really pivot and I guess really help you choose a direction and an exit strategy in itself. But then most importantly, from what I'm really hearing here, make sure you don't buy something that is going to be super difficult to sell. Because if your plan is, I'm going to sell this, then you don't want the thing that no one wanted when you bought it, cheer that you got it for such a bargain, and then it takes you 6 months to sell, 12 months to sell, something goes wrong with it. You want to make sure that you can put it on the market, get a nice sale going quickly.
Absolutely. And then lastly, in a true accounting spirit, make sure you get your structure right for what you're aiming to achieve, because it's all well and good to make money, but if you're giving a large portion of it away to the ATO, it's a big cost. Interest and tax are the two biggest expenses on our property portfolio. So if you can really hone in on a structure that kind of meets all those 3 requirements that we just discussed, Todd, then that's going to ensure a large portion of the profit that you make stays in your back pocket, which is going to help you accelerate on the other side of your property journey, which is acquiring other assets in other places.
Yeah, because they don't even really send you a thank you card when you pay a big bill, do they? It's just expected. No gratitude.
You get this thing called a notice of assessment of where your hard-earned dollars have gone, but they never leave the you pocket in there. So how much of that money went to you? So that's as much as a thank you card as we get, a notice of assessment.
All right, Jeremy Iannuzzelli from Praedium Partners. As always, mate, thank you so much for jumping on the show. You're an absolute wealth of knowledge.
Thank you, Todd. And yeah, looking forward to hearing the next couple of guests, because I think Gilbert really deep diving into the data is going to be fantastic, and Max really discussing quite deeply into the financing side of things are going to be some fantastic inputs there. And they're things that, if you're listening, make sure you tune into those 2 episodes, because they're really going to set the scene of what you need to think about when you're going in and out potentially of these areas.
Absolutely. Thanks again, Jez. I'm sure we'll be chatting with you again soon. All right, so realistically, biggest takeaways from this, talking to Jez, no land tax in NT. Massive bonus right there. If you guys agree with him and think it's more of a get in, get out kind of market, then making sure that you've got the correct structure set up from the beginning is potentially going to minimize the hell out of your tax. So absolutely make sure you're talking to an accountant beforehand. Making sure you've got your exit strategy. Breaking it into the 3 points that Jeremy was covering. How old are you? Like, are you looking at doing this in your 20s, or are you looking at doing this in your 50s? That's going to have a massive impact on how quick you're looking at getting in, getting out. Whether it's transactional or longer term, the term is going to change completely. What is your plan for it? Are you looking just for the higher yield? Is it like, I can get a 7% yield there and nowhere else just about? Then that's the plan. That's obviously going to change things for you quite a lot as well. Or are you looking at it from more of a, I think this is going to double in the next 12 months, 24 months. I'm going to really try and time it. Again, you've got it structured from the beginning. You've got a solid direction to keep focused on. And finally, I thought this was a great point and so easy to overlook. Buy something that's actually sales friendly if your goal is to get in and get out. Because when a market does soften, and I can tell you this from many, many years of being a sales agent, it can get hard to sell even good stock. Bad stock, no one wants it. So if you are wanting to get in and get out, maybe getting the thing that was a super bargain that no one wanted at the time in a good market, not a very good idea. Make sure you're getting something that actually has a wider chance of not only investor appeal, like Jez said, but owner occ appeal as well. I think those are 3 amazing points to cover off on. But right now, let's start chatting with Max Phelps and find out more of an investment point of view from purely through the lens of a mortgage broker. What do you guys need to understand about lending? What are the do's? What are the don'ts when it comes to buying in Darwin? Let's chat with Max now. Max Phelps, how you going, man?
Really good. Thanks. Always great to see you.
And it's always a pleasure having you on the show. And this one, we're going to be unpacking a lot of good stuff, both wearing your investor hat and also your mortgage broker hat. Talking about a few things around borrowing capacity, which I think a lot of people are going to find very interesting, but then also a few absolutely do not. And I think some of this kind of applies if you're in Darwin or not in Darwin, but very much for Darwin at the moment. And then a little bit about trust lending. Now, I want to kick that off with trust lending, but is there anything you really want to talk about before we jump straight into it, mate?
Well, see, Darwin, I think, is one of those places that we're only really talking about because it's got the label of capital city. Otherwise, it's quite a small place that if it wasn't a capital city, it probably wouldn't rank and get an episode. But because it is, it appears on all the reports. And so here we are with a little tiny city that it's a beautiful, great city to go to, by the way. Great fun, good party town.
Yeah, but you're right. It's not big. Like we said it before. It's like Townsville is actually bigger than Darwin. When you think about it that way, it's like it's a little bit of a shift because you just kind of assume it's big when you haven't been there because it's a capital city.
Yeah, that's right. In fact, depending on where you look, Cairns sometimes ranks higher as well. So depending on where you draw the boundaries of Darwin and Cairns and Darwin are very close together in size.
Yeah, right. Okay. Well, onto the trust lending side of things, I wanted to chat with you about this because we've just got off the call with Jeremy. He's basically talked about Darwin from a whole bunch of different perspectives, both with his accountant and investor hat on. But he was really talking about using a corporate trustee structure. And I wanted you to maybe open up a little bit more about how lending changes if someone was to go down that route and really what they need to be aware of before we get into the rest of it.
You know, I'm a huge fan of corporate trust lending. I don't like buying property in Australia in my name, but I'm happy to buy property in Australia in a corporate trustee structure because it does separate out the borrowing.
Yeah,
sorry,
you lost me for a sec there, man. That big pause.
Well, I don't own any property in Australia in my name.
Got it. Okay. Yeah. All right. Anyway, dramatic effect.
I'm more than happy to do things in the corporate trustee structure.
Gotcha.
I mean, there's some extra costs of running a corporate trustee, which, you know, the setup costs and the running costs, which accountants will overblow them sometimes in terms of the absolute numbers, but they shouldn't really be that punitive. However, one of the big things is the negative gearing. So in a corporate trustee structure, if the trust makes a loss, the loss is locked away in that trust until it makes a profit in the future. So you can't just get the tax back on it. So places with a high yield, which of course Darwin currently has, means that it's much less likely to be in the negative anyway. And therefore, that's one of the downsides of a corporate trustee structure that pretty much evaporates. And the other one, of course, is land tax. Land tax can be problematic in some of the southern states with borrowing in a corporate trustee structure, whereas in your own name, you might get an allowance, but in a corporate trustee structure in New South Wales, you don't get one. South Australia, you don't get one. It's tiny.
It's basically non-existent, but I hear what you're saying. But can we open up the negative gearing side of things a little bit more? So just to expand on it, if I've got you right here. So when you've got a property in your own name and it's negatively geared, that way the bank will look at that and go, okay, we understand that you get a tax offset. So we'll take the serviceability like through a bit of a different lens, but because you don't get that same tax offset in a trust, then it's not going to service as well. That's basically what you're saying?
Servicing differences in that are quite small, but it can be quite big for some lenders. So the trick here is to understand the difference between tax deductibility and negative gearing. So there are one or two banks, and let me give you a quick example. Imagine a property's renting for $500 a week. That's $26,000 a year. Then the banks typically only count 80% of that, which would be 20,800. So I'm just doing numbers in my head, which I probably could have pre-prepared this if I was smarter, couldn't I?
So roughly 20 grand, let's say.
But roughly 20 grand is what your income is. Now, let's say that on that property, you've got a $500,000 loan, and we'll round the numbers off at about 6%. I know that they're probably slightly higher, but let's call it 6, just for the maths, make the maths easy. Well, that's about 30 grand a year in lending. So you've got 30 grand in mortgage and 20 grand in income. The negative part then is the 30 minus 20, which is 10 grand. You're 10 grand negative. Now, the difference in servicing on that 10 grand negative is not huge, but there are one or two lenders that, because their rules say no negative gearing, then they don't allow any of that as a tax deduction. And so therefore they assume the 20 grand is all getting taxed at your marginal rate, which means all of a sudden you could be paying 10 grand in tax. Now the difference between the two is massive.
Gotcha.
So the key thing is when you're looking at negative gearing, it should be the difference between the two, which most lenders, because it's not allowed, most lenders don't count for it in their calculators, but then some go one step further in their calculators and they don't count any deductibility at all and fully assume that you're paying tax on everything, and then saying, right, your after-tax income, the 20 grand is 11, and now you've got to cover a 30 grand mortgage with an 11 grand net income. So again, as always, if you talk to a broker, because we just run it through the calculator and go, oh, that one's shit. We're not using that one. And we just go to a different lender who doesn't do it the stupid way.
So basically what I'm hearing is not every lender is the same. That's not a blanket rule. That's a very lender by lender, case by case. But as a whole, if you've got a property that is going to be positively geared or neutrally geared in a trust, it is still going to work better for you.
Correct.
Yeah.
But again, the silly lenders that don't allow the deductibility, even if you had a smaller mortgage and a high yielding property, so let's assume the same mortgage of 30 grand, but actually your rent was 30 grand, so it's neutrally geared. Well, that should be fine, and it is fine with a lot of lenders, but some lenders will assume that the 30 grand is non-deductible, and so therefore they go, oh, you've got to pay tax on that 30 grand, so therefore you only get, 15 to 20 grand depending on your tax bracket, and you've still got to cover that 30 grand interest payment. So we just don't use them for that sort of thing unless there's a surplus.
Sounds like it's way too complicated, and it's much better to just make sure that you're doing the simple road with this. But if you're doing it in a structure, the other big benefit that I wanted to talk with you about, actually structure or your own name, is the yield increase and the potential borrowing power increase, because I think this is one of the massive benefits to Darwin right now, because its yields are 6-7% in some cases.
Well, I love that. You and I were just having a chat just now, and because I'm a bit of a nerd and I've got calculators up the wazoo, I just quickly did the numbers and said, supposing someone only had the borrowing capacity to buy a $450,000 property. You look around the country and you go, what can you buy for $450? And it's really quite difficult unless you're going super regional. But that's always based on a yield. And so if we assume that $450 was based on a 5% yield, then we can go, hey, what about Darwin? Darwin's got more like a 7% yield and 6 or 7% depending on the location. And if you can get a 7% yield, that 450 borrowing power can jump to 590. And suddenly you're buying a house in Darwin instead of some unit up the back of nowhere, somewhere else in the country. So what's it, 450 to 590, did you say? Yeah, 450 to 590.
That's huge. Okay, so what is that, $140,000?
$140,000, yeah. So it's justifying a much bigger borrowing power. And obviously, if 6% gives you a break in between, that's about a 70 grand difference.
So either way, huge. Now, if it is in a trust then, is that still calculated the same way, or is that just... Yeah?
Yeah, absolutely, yes. Because of the negative gearing tax deductibility question, it's more complicated and we have to throw it through the models and see how it looks. But for a simple, if it's in your own name, this is how it works perspective, then going from 5% to 6% would up that 450 to 520. Going from 6% to 7% would go from 520 to 590 with some lenders, because some lenders cap the yield at 6%. So some lenders have got if you're getting a 10% yield on your property, they're only going to count the first 6% and assume the rest is bullshit or can't really happen or temporary or something. I don't know, but they don't count it. So there's a few lenders that don't do that. Again, part of the benefit of working with a broker is that we just go, we're not
working with them.
Yeah. You've got a great yield here, we can get you the money, but we just can't work with those lenders over there.
And I wanted to ask you as well about the form of volatility that's happened in Darwin. Like, it's no secret. It went crazy, then it went flat, then it went down. And we've heard stories before of people going into negative equity. We chatted about this a little bit with Jez, but on the lending perspective, I wanted you to unpack really a few things people absolutely need to be aware of to protect themselves if there was any kind of real market fluctuation again in the future.
Yeah, well, this is the one thing that everyone needs to know before they buy in Darwin is this volatility. Because it's a small market, it means that a small number of investors from down south can suddenly jump into Darwin and have a big impact on the local market and send it skyrocketing. But then ultimately they might back out, or the locals go, we can't afford the property, and then the market falls. Now, I've seen this from a client of mine. They had a $480,000 mortgage on a property they bought in Darwin when they were living there. And the property was worth $600,000, and that was totally fine at the time when they bought it. The problem is that they came to me a few years later, and as always happens, you know what banks are like. After a while, they're ripping you off in one way or another. Your rate becomes more uncompetitive over time. They're always offering better specials to new clients, and you're out of the market. We couldn't refinance them because that property was now worth $500,000. So they now have a mortgage of $480,000 on a $500,000 property. We can't refinance without pulling the equity from somewhere else. So all of us, we're not going to go and get in the 95% refinance loan. That just doesn't exist. But if we want to do this at 80%, we've got to find 80 grand in equity from another property. And it's another reason why you should just be really, really careful with a volatile market like this, that you don't end up in negative equity, or you guard against this problem. And one of the things that we spoke about before is, do you ever cross-collateralize? And I've been a broker for 16 years. And I've cross-collateralized once. And I remember when I did it, and I remember why I did it. And it was for one special customer, for one special set of reasons that got him a super, super duper rate. But otherwise, I don't do it because it gives you flexibility where you don't have it otherwise. Now, had this client of mine cross-secured their property with another one, we wouldn't be able to pull equity out of the other property because of the negative equity in the Darwin property. So when properties are crossed, banks are looking at the combined value of those two properties. Is your lending below 80% of the combined value? Well, if one is fallen in value and one's gone up, well, you can't pull the equity out of the one that's gone up. You've got to offset the one that's gone down. So whereas if they're not crossed, and thankfully this client of mine that was in this situation wasn't negative equity, it was just really, really low equity. They got, having 120 grand in equity to 20 grand in equity, but at the same time, they were able to use the equity in another property for another purchase instead of having to offset the shortfall in the Darwin property. So it's just super important. Please, if you ever want to sell or refinance a property, then you don't want it cross-secured with anything else. But just be mindful, in Darwin, we've got this volatility, which is to be expected because you've got a small area with a lot of attention because it's a capital city, and that can then suddenly drive prices in a great way if you're trying to build up equity and sell. But at the same time, everyone pulls out and the market can tank. And that's not a great place to be in.
So to put it really simply, if you had two properties, let's say one, and whether it's Darwin, Sydney, Melbourne, Adelaide, doesn't matter. One property's in a great growth location, let's say, and you bought it for 500, now it's worth 700. The other one was worth 500, then it was worth 700. Then fast forward another year, and let's say that's just absolutely tanked, and now it's worth 450 or 400. So one of them you've still got 200 grand worth of equity in, but the other one you've actually now technically lost 100 grand's worth of equity in. If they're cross-securitized or cross-collateralized, then you really only have that 100 to play with. Whereas if they weren't crossed over, you would still have the 200 over here.
Absolutely, yeah.
Got it.
You can still borrow 80% of that 200. In fact, one of my very long-term clients had this with, Perth had the same problem between 2019 and 2014.
That's right.
2019. Perth went backwards, and he bought a property in Perth with a 97% loan at the time.
Oh no, I can see where this is going.
But the great thing was we used some equity from his home as a deposit, but we didn't cross-secure them. I said, mate, we're not going to cross-secure because it's too risky. So he didn't have a lot of equity at the time either because he was very overextended with his portfolio. When he's buying with a 97% yield and it's not 90% LVI, I thought he was doing really well. But it meant he then had great growth in one of his other Sydney properties, and he was able to just pull out the equity, use it to buy something else in Brisbane, which at the time was when Perth was tanking, Brisbane was kind of booming. And so he was able to capitalize on that. Whereas if he cross-secured, he would have just had to wait until Perth recovered before he could buy again.
And one thing I want to make really clear is this is absolutely not a bashing Darwin's piece on this. This is about making sure that you're protected as a property investor, because you don't want one potential choice to kill the growth of the rest of your portfolio, especially if you could have moved forward with it as well. Because this can happen. This isn't just exclusive to Darwin. It has happened in Darwin in the past. So it's something that you really want to be mindful of, and just something that you want to protect yourself as much as possible moving forward. But something else I wanted to... So you got something to add there?
Touch on that. But yeah, because this is, we're in early 2025.
Yep, Feb 25. We can timestamp this.
We always look at the downside risk of anything we do.
Yeah.
So the downside risk at the moment in Darwin looks really low. Now I could be wrong, and it could go down further. We don't know because it's anything can happen. But when we look at local people in Darwin can afford comfortably, on a very average income, can afford to buy an average property in Darwin, which is absolutely not the case in Sydney or in some of the other cities. That very average incomes won't get you an average property. They might get you something, but they won't get you the average property. Whereas in Darwin, they absolutely will right now. The first thing. The second thing is that when you look at the price of established property in Darwin, you can't build, and you can't make new stock at that level.
Below replacement in some places.
Yeah, that's right. So the risk of it going further down is like, well, one of the downsides of Darwin is that the population growth is not huge, but it is still 1% a year, but you can't afford to build new houses. If the new houses you build are more expensive to build and the established ones are so much cheaper, no one's going to buy them. You've got huge incentives at the moment. As a first home buyer, you can get 50 grand towards a new home. Even if you're not a first home buyer, you can get 30 grand towards building a new home, because they want to encourage that building. So it's a very friendly market for doing that, because at the moment it's very hard to build something and have it value because the market's lower. We talk about the risk of negative equity, but that's more of a over the long haul. At the moment, right now, the downside risk to me looks really super low. But again, anything can happen over any period of time. So, don't hold me to anything, make your own decisions, do your own research and all that kind of stuff.
So I wanted to ask you about postcode restrictions. Hardly anyone ever talks about this. Is this something that's like, not applicable at all? Or does that kind of come into it a bit with Darwin?
It's highly unlikely to come into it. In any capital city, in any big city, it's unlikely to play, except for some smaller lenders who might try and kind of mitigate their risk. We had a couple of tiny lenders move away from the Perth market, for example, a few years ago because Perth was falling. But the major lenders, they just carried on lending and then just assumed things would right themselves. The postcode restrictions tend to be in places either where there's been, if it's in a capital city, it's where there's been massive amounts of high rises suddenly built in the one area and things become problematic, or it's in regional and remote locations. So, the sort of more far away places that it's much harder to get lending. But it's when we're in a city, and Darwin has the benefit here of being a capital city, they're seen as being a bit more robust and less likely to have postcode restrictions. That's not to say they won't happen or they're not happening right now, but it's just far less likely to happen. And anyone wondering what postcode restrictions are, it's when lenders, or more importantly, mortgage insurers, put a restriction on lending to a specific postcode. So it could be one single postcode, or it could be a cluster of postcodes that cover an area within a city, or it's a whole remote region where there's been a lot of volatility, and typically it's mortgage insurers are more likely to do it. And mortgage insurers back out of that market, it makes it much harder to get lending, especially for locals. As investors, we might not be paying the mortgage insurance, although some of us do, but the locals are very often using mortgage insurance, and then you're limiting your resale value in that area because you can only get to people with a 20% deposit.
Gotcha. And so basically wrapping up everything we've gone through, trust lending, if you were to buy in a corporate trustee structure, some of the benefits of this is basically negative gearing in a trust is going to make your borrowing a little bit more restricted, because if you're buying in Darwin, then you're looking at an area that has such higher yields, the chances of being negatively geared are a lot lower. A lot of the time you're going to be either neutral, slightly negative, or possibly even positive in some cases. Then on that note, as far as your borrowing power is concerned, the example that you just gave, and obviously there is a lot more variables, check with your broker for your personal situation. The example that you just gave before, Max, was the difference between a 5% yield and a 7% yield was the difference between 450,000 and 590,000. Massive difference on the yield. So some huge potential benefits there on the lending side of things. Postcode restrictions, not to worry about. Cross collateralization, avoid it like the plague. That is like absolutely a big no. And any final thoughts, Max, or anything else you wanted to kind of add into this one as far as your property investor hat or mortgage broker hat, mate?
Yeah, I think we just have to remember that property is cheap for locals. And so when property is cheap for locals, the potential upside is good. So would I generally consider Darwin? Probably not, because the population is small and pop growth is low. But would I consider it as an investor right now based on great yields, low downside potential, and potentially good upside potential with affordability? Yeah, I think it's definitely worth considering as a cash flow play. I'm not sure I agree with Jez about the short-term thing, because the get-out costs are quite high, but at the same time, it's possible. Some people do really well buying at this time in a market where it seems to be quite cheap, waiting for the run and then bailing. But timing the market is a very tricky thing to do, and it's not something that I would normally encourage. If it's what you want to do, this is probably one of the places and one of the times to consider it.
Very well put. Max Phelps from Golden Eggs. It is always a pleasure having you on the show, mate. Thank you so much for your time today.
I always love coming on and chatting to you, Todd. Peace from Property is one of my favorites. Thank you.
So the massive standouts for me here, extra borrowing. Like we're not just talking about, oh yeah, sick, that'll increase your borrowing by potentially 10 grand. Like this is a significant extra borrowing power. And again, everyone's situation is different. If you earn an amazing wage, but you've also got a habit of going to the casino every night, this isn't going to help. You've probably got to fix a few other things in your accounting first. But for all things considered, the difference between getting a 5% yield, which is already a pretty strong yield these days, and a 6 and a 7% yield, remember was it 450 to 590 for the difference between a 5 and a 7 in this scenario? That's huge. It can sometimes be the difference between actually getting another asset and building your portfolio or not, or acquiring an asset that's got even better growth potential to it. The other thing, cross-collateralization. Like, I feel like this is something that everyone should be staying away from anyway. I'm yet to hear a scenario of like, yeah, cross-collateralization is just the best. I've heard a few very, very rare cases of when it's been used as an absolute last resort. But again, can't emphasize very, very rare enough. And now if you've got a bit of a better understanding as to how that actually can hold you back in portfolio growth, if you think Darwin's a good fit for you, everything that Jez has said so far, everything that Max has said so far, and you want to move forward with it, absolutely keep this in mind. And as far as the final thoughts, I think Max is kind of wrapping that up pretty well. Like in some areas, it's like it's below replacement cost. So this so much isn't like is Darwin going to tank from where it is? This is more of the cautionary tale that I'm really hearing. And the common connections between our two experts so far is more so if it comes up, but then if it goes back down. But if it comes up, you extract equity up here. If it does come down, which no one knows, you don't want to find yourself in a negative equity position, in a position where things were great last year and horrible the year after. But now it's time to unpack the data behind the area. We're going to be talking about Darwin as a whole. We're going to be talking about some key suburbs where you can potentially still invest for like under 500, 550,000, some cases in the 400,000s. We're going to be unpacking peak rental demand periods, which is absolutely something you want to stay tuned for, because depending on when you buy and when you settle could sometimes be the difference between having a property that sits there vacant and something that just gets snapped up straight away. The data paints a really interesting picture there, as well as demographics, historical performance, trending data, so much more. Right now, let's jump into all of that, plus so much more, with the founder of Suburbs Finder, Gilbert Melgar. Gilbert Melgar. I think a lot of people are wanting your opinion on this, mate. We're talking Darwin. How you been?
Good, mate. Good. Thank you for having me again.
It's always a pleasure having you on the show. And I know you've put a ton of effort behind everything you've put into today's episode. You and I were going through a little bit of this off air. The paper you've put together is pretty detailed. So I'm looking at pulling this apart so we can all understand the detail behind Darwin from an analytical data point of view to really sort out the pros, the cons, what people need to be maybe happy about, maybe what people need to be a little bit more cautious about. But it's sort of really stripping back the opinion and going into what are the numbers actually tell us. So is there anything you wanted to set the stage with before we jump into it all, mate?
No, let's get onto it.
Beautiful. Why don't we start with the economy of Darwin as a city?
Well, Darwin as a city has a gross regional product of 13.4 billion, right? And that is for the year of 2024. But if we look at historically, all the way back to 2008, it's been increasing over time.
And when you say increasing, like back in 2008, it was 12 billion, like it's just been sort of hedging along?
Back in 2008, it was 8 billion. Right?
Okay.
2009, 8.5. 2010, it went down a bit. Right? So that's not a bit, but that's from 8.5 to 6 billion. Right?
So a lot.
And
back
then,
okay.
Yeah, and then it went back up 2011, 6 billion, and then 2012 at 6.6, 2013, 7.2. 2014, 8.2. Yeah. And then keep on going up.
Okay. So it's been growing. So it's certainly not in boom time, but it's also not a city that's shrinking.
Yes, exactly. And also the employment rate at the moment is at 3%, which is considerably low compared to Greater Darwin itself and to the rest of Northern Territory.
And how does 3% compare to like another major capital city, like a Sydney, a Melbourne, Adelaide, Brisbane, Perth, something like that?
So compared to Brisbane is 3.8, and compared to Sydney has 4.5.
Right. So it's actually pretty good as far as the unemployment rate is concerned.
Yes, exactly.
Okay. What are some of the other stronger economic factors that Darwin's really showing that make you go, yeah, okay, these are some really good positives here?
The per capita of Darwin is 166,000 for 150,000 people living in there.
So for anyone that's wondering, what do you mean by per capita? So this is like the average wealth per person?
Yes, exactly. But if we compare that with Townsville has 90,000. It's because Townsville has more, the population is bigger.
Gotcha.
Population is 200,000 people, right? And if we compare the GRP, gross regional product, Darwin's 13.4 versus Townsville 21.3 billion, right? So the per capita is lower due to that there are more people living in Townsville.
So if that's how it works then, with like a higher population, lower per capita, you're just saying the comparison between Townsville and Darwin, does that mean that Sydney's then got a lower per capita? Because I'd imagine it would be higher because higher property prices, like stronger economy. What's Sydney's? How does that sort of play in together?
Definitely, because Sydney's GRP is 141 billion, right? But because of the population, Sydney's per capita based on GDP is 81,600 plus.
Wow. So Darwin's almost double.
Lower. Yeah, it's more than double or almost double. Yeah.
That's huge. Okay. Look, before we get into the property side of things then, is there anything else you wanted to talk about economically for Darwin?
Economically, well, the top two industry of employment are public administration and safety and healthcare and social.
All right, so we're looking at 13.4 billion GRP, unemployment rate pretty strong. As far as the per capita rate, it's looking really good. So Darwin doesn't grow massively, but it has been growing. Like it's trending in the right direction. It's just not boomtown. But why don't we start drilling down a little bit more into property prices? Can you tell me a bit more about capital growth trends in Darwin?
Well, capital growth trends hasn't really increased because the highest compounded growth rate that I saw based on the data is only at around 3%. And that is not huge compared to the other regions or the other LGAs or the other suburbs that we have.
So just so I understand, you're talking about 3% per annum over the past 5 years, 10 years? How long?
3% compounded growth rate over the past 10 years.
Over the past 10 years. Okay.
Yes.
All right, so we're talking 3% capital growth per annum over the past 10 years. So like this place has been repressed.
Yes, we can say that.
Okay. So what about a little bit more recently? Is it actually starting to tick up or is it still very much asleep?
Supply and demand data started to move, right? So we can see that demand over the past 2 to 3 months, it has been going up, and then also supply has been a little bit going down, and the interest on the number of people looking at the for sale section with the interest of buying in the region has also increased, but not significantly.
So one of the things that kind of brought the attention to Darwin for us was like a few years ago, we did an episode, Is Darwin Dead? Like just no one was ever talking about it as a potential investment spot. And then all of a sudden we read out an article on APN, like our Friday news show, and it was about how the search on like realestate.com and domain just skyrocketed out of nowhere. I was like, okay, cool. So there's some interest around this. Let's start looking a little bit closer. Then talking to more and more professionals in the industry, it's like, yeah, there seems to be a few more people starting to buy there. I wanted to know from your perspective, because I know like you guys actually break down this data on like how many people are looking at suburbs, even down to that suburb level. Is that just a little bit of a blip short term? People were kind of searching for a stronger yield and they've gone away? Or is that actually starting to really creep up and stay consistent the more people are looking?
Yep. So it would be better to explain if I can share the screen.
Yeah,
right?
Of course. Go for it, man.
So looking at the number of potential buyers, so these are the people looking at the for sale sections of different online listing sites, right? So we can see over a period of time, it has been increasing. So the blue one is for all type of dwellings, and then the purple one is for houses, and we can see here the one for units as well, right? So majority of the people they're looking for houses, right? So there are also looking for units, but not as much as the people who prefer houses, right? So we can see here that it has been going up and down, but so far it has increased for the month of January. But we can associate that this dip right here could be because of the seasonality. Yeah? Because if we can compare that, that is every December, right?
Yeah. Gotcha. Yep. That's a very consistent drop. I mean, and it always happens with a lot of things. So December, that's the time that you're buying presents, you're spending time with family, like it's all happening.
Exactly. Yep. And we can also see what are number of people that are potentially wanting to rent the property, right? So it's been
that's pretty
flat,
consistent there.
But consistent.
Can you go back to, is it Jan 22, Jan 21, Jan 20? There's some real spikes around January as far as rental demand.
Yes, so we can associate that as there may be a seasonality factor in there, right?
That's so very good to know.
If you are an investor, if you want to buy during that, you can time in your buying window.
Yeah, try and settle in Jan, but look at this.
Or if you buy it, you can try to sell it in January.
Yeah. All right, so as far as the demand's concerned, if we go back to potential buyers on that tab, if you click on that, it looks like it has been going up. Like if we compare that, looking all the way back to like 2021, it's not going up sheep stations, but it still has been increasing over like the past kind of 5-year period. But I think it was somewhere around that kind of mid to possibly later 24 it started picking up. So can we focus on that part there just to see what kind of an uptick are we talking?
Yep. So lowest during 2024 was April. So that's 9,721. And then the peak would be sometime August, would be 11,800 plus. Yeah.
Okay. So what is that? Like a good sort of 25-ish% just off the top of my head of extra people looking?
Yes, exactly.
Yeah. Yep. Okay. So no, like not incredible, but it's definitely a significant uptick in as far as the amount of people searching for property in Darwin.
Yep.
Okay. All right, and while we're actually screen sharing, Gilbert, do you mind actually opening up a little bit more about growth trends, like so we can actually visualize some of this data? And for anyone listening on iTunes and Spotify as well, head on over to our YouTube channel so you can see all of this. But we can look at a little bit of rent, a bit of price growth.
Yep. So in terms of the median price, we can see here that it's been pretty flat since end of 2022, which is sometime around October. Yep.
Yeah, okay. So is that around 560? It's pretty much just, been the same kind of 560, 570. And we're talking for the past 3-ish years. So, but there was a little bit of an uptick then before COVID. So 2020, can you scroll it back that way around 2021? So it was sitting around for houses around the sort of mid 4s. And then it increased by about 100 grand by the look of things. And then that was it.
Yes.
Okay, so I can definitely see why people are looking at this through the lens of the potential value play, because now it's a case of you're getting some pretty solid yields. You're looking at a market that's been repressed for a very long time. But I guess like we spoke about with Max and Jeremy, historically, it hasn't had the best track record of having a great run and then staying there. It's had a track record, unfortunately, of having a great run and then kind of coming back and really coming off the boil in some cases. So if this is more of a yield play and things are set up correctly, like we talked about with Max and with Jeremy, can you open up a little bit more about the rental demand side of things and the rental yields?
Yep. So we'll look at the potential renters. So we can see here that it's been pretty much consistent, right?
Over got those January upticks we saw before.
4 years, yes.
Yeah.
Yes. And looking at rental yield, so the yield has, even pre-COVID, has always been at 6%.
So high.
Or 5% and above, right? So this means that both median price and median rent are going up over time because it's maintaining the yield throughout.
Can you go to the rental yield for units, just out of curiosity? That green line's getting off the charts there for what it is like right now in Feb 25. What is that sitting at as the median yield all the way at Feb 25? Like the highest point?
7.71.
7.71. So that's like the median yield. So you could potentially buy a unit up there and get like an 8-9% yield.
Yep.
That's off the charts. Okay. And it doesn't take a genius to look at the data and see why there's people going, hold on a second, I need some cash flow. Here's a cash flow play. Here's a market that's been repressed for a while. There's some potential for capital growth here. Plus, I can get some pretty good yields.
That is totally correct, especially when their goal is balancing their portfolio.
All right, but it's not all massive yields and potential repressed market that was actually not potential. It has been a repressed market that's got some potential capital growth. There's more at play here and more that you need to understand about Darwin. So can you start unpacking a little bit more about like the demographics, the social makeup, that kind of stuff?
Yeah, definitely. So one perfect example of that is the IRSAD, or Index of Socioeconomic Advantage or Disadvantage. So the higher scores in recent years indicate an improving socioeconomic profile, right? Which can attract higher income and tenants and owner-occupiers. So one particular suburb that I had a look, forgive me if I pronounce this incorrectly, Tiwi.
Yep. So it's Tiwi.
Tiwi. So the IRSAD score for 25 years, because I always look at the trend, not just one timeline. So in 2001, it was 10. 2006, it was 8. 2011, it was 7. 2016, it was 8. And 2021, it was 7. So the demographics is, I would say, affluent, right? So anything above 5 is definitely advantageous in terms of the demographics.
Gotcha. So we're talking about Tiwi under the lens of, for its comparison to where like everything else that's around, it's one of the more advantaged demographics as far as what the data is really showing there. So you're looking at this as if someone is going, okay, Darwin's like the place for me. This is an area that they want to do a bit more research on.
Yes, definitely. So what you want to do is you want to go to macro and then all the way to micro. So from the greater capital city area, LGA, and then down to the suburb. And then when you're looking at the property, then at the street level.
Got it.
As much as possible. Yeah.
And before we get into a little bit more of days on market, vacancy rates, those kinds of data points, mate, is there a few areas you can share? Something that's like maybe even below $500,000 for anyone that's really looking at this going, I'm approved for 480. Like I'm doing this on more of a budget.
Yeah, definitely. So let me just share my screen. Let's say our budget is under 500, right? So we'll put this up. So let's say 525 just to cover everything. Okay. So far we have 5. So these are Burima, Karama, Malak, Alawa, and Wagaman.
So this is median house price of like 510, 517. We've got a 450 there as well. So as far as actually picking up stock in the 4s, if that's where the median's sitting, like there's still potential to buy. Buying stuff in the 4s just seems almost impossible these days.
Yes, it is definitely hard. That's one of the reasons why there's limited in there because of the budget constraints that we have.
100%, man. And I'm not familiar with Burima, but what is that? $250,000 price and a 17% rental yield. You got to click on that, mate. I'm curious. I've never seen this area before, but I'm sure there's a lot more to this story.
Yeah, so it's previous sold. Let's see, sold.
This might just be a little bit of a data blip, maybe.
Yeah,
just a few sales.
The reason why is there could be sales like this that has pulled down the median.
Yeah. And this is something that you guys have got to be aware of in the data as well. Every now and then, stuff like this can happen. I remember years ago, Adelaide never used to have apartment buildings. And then one day a developer built a high-end apartment and the median apartment price was like 300,000. Then they sold a whole bunch of apartment stock for like 600,000. And then technically on paper, the median price for apartments like doubled within the space of a few months. But really it was just because a whole bunch of new high-end stock got sold in such a small time frame. It's the same kind of thing. Every now and then you will see little data blips like this that you have to be aware of, because otherwise it can lead you chasing a false positive or a 17% rental yield.
17 plus, yeah.
Yeah, that does not exist.
If it's too good to be true, then you have to really check it, because that's one indication of, I would say, kind of a red flag, right? Because it's too good.
100%. But I mean, here's just a few areas though, that if you've got a budget of 500 or under, to at least have a little bit of a look into. And just to open this up in a little bit more detail, Gilbert, can you actually pin like 3-month price change, inventory levels, so we can see a little bit more about like pressure and growth?
Yep, definitely. So in here, you can see the 3-month price change. So all of the 5 has been pretty flat. 1 even has a negative. So that means median price has gone down over the past 3 months. And there's only one suburb that has increased at 3.75%, which is the Wagaman.
Gotcha. And looking at those inventory levels, they're still very low. So 0.5, 0.9, 0.4. And this is all the more reason to understand why you never want to look at a data point in isolation, make a decision off of that. Because looking at this, it's like amazing. You look at the inventory levels, 0.4, that's amazing. But then you look at the growth and it's like 2%. Or then there's a 0.9, it was minus 10%. This is always about weighing up the rest of the picture as far as the data is concerned. But is there anything else that you wanted to really add to with these areas, Gilbert, before we move on, mate?
Yeah. So definitely, since you mentioned already, so if we can add, then definitely we should also look at how has it increased in value over the past 12 months as well, right? So looking at that particular suburb, Wagaman, so in the past 12 months, it has increased by 8%. So we can see that there's a continuous growth in that particular suburb compared to the other 4.
I got a feeling searches in Wagaman might pop up a little bit after this episode has aired, mate. All right, wrapping things up, Gilbert, what's the biggest thing you really want to leave people with understanding when it comes to Darwin from a data analytics perspective?
Yeah, Todd. So definitely you've already said a while ago that we shouldn't be looking on just one particular data in isolation to come up with or to help us with our decisions. We should also factor in multiple data factors. So that would involve an indication if the rental demand is strong, right? Demographics, and, are we looking at short-term equity release, right? Or are we looking at cash flow, right? So these are the factors that we need to consider in looking at this area. Plus, it also doesn't hurt calling up or ringing up local agents or real estate agents or local property managers in the area to ask them questions, right, about what's happening in that area. Because the perfect combination would be combining the data or the numbers that you see with the local knowledge of the people living in that location, right? Especially if you're buying overseas, not overseas, but
interstate. I know what you mean.
Interstate. Yeah.
All right. So you're talking about the importance of really getting boots on the ground, like get the data to get you to a certain point. But then if you can't fly there, at least talk to people that are there, making sure that you're really getting the understanding through the locals lens, not just what the numbers are saying.
Yes, that is totally correct.
Excellent, man. So looking at Darwin overall, it absolutely has picked up as far as its inquiry levels, but it also then started to drop back down as well. So it's not like a complete upwards trend. We're looking at the growth over the past 10 years of being pretty much non-existent. It wasn't a complete no, but was it like 3% or something?
Yes, it was 3%.
3%. It's got a pretty strong unemployment rate. Tiwi, if again, and apologies if I'm pronouncing that wrong, is looking like, if you are looking into Darwin, got some pretty strong data points about it. There's multiple areas if you're still looking at getting in under the $500,000 mark that, again, you need to look at all the data for it, but it's a good place to start if you're on more of a restricted budget.
Yes.
So wrapping it all up, Gilbert, as far as Darwin's concerned, if people are wanting a strong yield, some capital growth play, obviously they've got a bit more of an appetite for maybe a little bit more risk. What's your thoughts on Darwin? What is the data really telling you?
Well, definitely, I can see Darwin has a lot of potential in terms of growth, but definitely it has huge potential for a yield factor, right? Especially for cash flow.
Big time.
But we also have to consider other locations as well. So if we can buy somewhere on the same price point, which will give you a better growth and better indication, like infrastructure to support that, like infrastructure projects and all, and with the same yield, then why not? Right. So there's a huge market out there. I guess I'll just end this to whatever will fit your strategy and within your budget and will help you achieve your goals. then definitely that's the one we should go to. Right?
Love it. Make sure you're getting what you need to complement your strategy and help you keep moving forward. Don't ever buy blind. Don't follow the pack. Make sure that you're actually doing your research, because by the sounds of what you're saying there from reading between the lines, Darwin's definitely got some potential about it. But is it the best option? Maybe, but maybe there's also others out there that can also give you a pretty strong yield and high capital growth potential. Gilbert Melgar from Suburbs Finder, thank you as always for jumping on the show, mate. You are always such a well-prepared person to have on. I love it, man.
Thank you again for having me.
That rental data, I'm finding that fascinating, and to see how consistent that was. That wasn't just like a blip once. That was like every year. Such a good perspective on that. And looking at this from more of an undervalued perspective, as far as the growth that Darwin's been experiencing, it's either nothing in a lot of cases, or it's even negative in some. Now, going back to what Max said a little bit earlier, like if things are already looking like they're pretty much below replacement value, and then things have already come off the boil, plus let's also talk about a little bit of what Jeremy's saying, what Gilbert's also touched on a bit, and I think Max, I think everyone's actually said this, because the market is so small, it doesn't take as much to move it. If more and more people start seeing this, and more people start going, I can see some real potential here. The picture that's being painted pretty clearly to me right now is that Darwin's potentially got some legs for some real growth, but I don't think it's going to be an area like a Melbourne or a Sydney that, because it's so big, like especially Melbourne right now. Melbourne's very much a value play as well, but Melbourne's huge. We're talking millions and millions of people living there, and we're talking so many dwellings. I'm going to say millions of dwellings. Whereas with Darwin, we're talking like 200,000. Like it's significantly less. I think all of NT, I think Jez said this, it's like 250,000 in the entire Northern Territory. So watching that market move potentially isn't going to take that long. And timestamping this episode, like I said, recording this in sort of mid to late Feb, it's going to be really interesting to watch this one unfold. But I want you guys to remember everything that we've talked about in this episode. And obviously, this is not financial advice. Please seek independent professional financial advice, because your situation is going to be unique. It is yours. You are the only you. But chat with your accountant. If you're looking at doing this and going, okay, what if I did use a corporate trustee structure? What are the benefits for me? What are the downsides for me? Chat with your mortgage broker. Hey, if I could actually get X yield instead of Y yield, how much more can I borrow? Is this worth it? If you're going to use a BA, chat with them about the timing of this. If you're doing it yourself and you're getting educated, making sure that you understand the market cycles and making sure you understand the data that we went through with Gilbert, getting onto platforms like Suburbs Finder, getting the information that you need to make an educated decision. Like, do not do this blindly. Do not just buy because it's like, okay, cool, it's undervalued. Boom, check, go. Maybe you'll do well, but maybe it will go horribly wrong. Eyes closed, head first, can't lose. It's one of my favorite Jake Peralta quotes, but I definitely do not live my life by it. But that guy makes me laugh. And if you're watching this, comment below, whether you're on Spotify or YouTube, let us know what's the next location you want a panel episode done on. You want to pull apart from not just like a yes, I'd buy it or no, I wouldn't, but more like the expert panel like this. It's almost like a bit of an unstuck, but instead of a person focus, it's like an area focus of like, let's talk to different experts and really pull apart the area. Comment below where you're thinking. If we get enough people going like, yeah, this is what I want, we'll make the episode. But I hope you guys have enjoyed this episode, and make sure to hit that subscribe button so you don't miss another one coming up. But otherwise, guys, my name's Todd Sloan. This is the Pizza and Property Podcast. As always, have yourself an amazing rest of the week. Stay awesome.